What's up guys, it's Dan at TPFX. In this video I just want to take a look at a really simple concept that is support and resistance. It's really important that you understand straight away support and resistance is not something that we trade, it's not something that we teach to trade, but I do feel that it's something that is massively misunderstood, and 90% of retail traders are looking at the wrong information when they are looking to find their levels. At TP we are only interested in identifying key levels of structure, and in this video today I'm hoping to be able to show you how we determine the difference from that. So let's get stuck straight in. So one of the things that a lot of people get wrong is what would happen if every single person in the world removed all of their money from the financial markets. So banks, hedge funds, financial institutions, retail traders, if everybody removed every single penny that they had in the markets, what would happen? 95% of people think that the markets would plummet to the ground, when in actual fact, what they would do is flatline. All of our candles would go as flat as a pancake and the price would stay where it was and move sideways. We need to think of it like a cruise ship. If you were in a cruise ship and the engines were turned off, it wouldn't come to an immediate grinding halt. It would continue to move under its own momentum for a little bit, so it would slow and then it would stop. Markets would do exactly the same. So we'd have a trend, we'd see the price slow, and then the price would just flatline and move sideways. So if we understand that, we then want to understand another analogy before we move into how we can identify the different levels. So for this example, I want to compare the Forex markets to a car driving up a hill. If we've got a car and we're driving up a hill, if we're going to make an assumption that when the car comes to a stop, the brakes are applied and it will stop, so it won't roll backwards. When the car's driving up the hill, you need to put your foot on the throttle pedal to keep fuel going into the engine to keep it moving up the hill. If you were to take your foot off the throttle pedal, the car would gradually slow down and then come to a stop. If we look at Forex markets the same way, if we've got a trend, if there is bare minimal volume or fuel in the tank pushing it in this trend will not last very long. Eventually, the markets will go into some form of consolidation and start to move sideways. Where these two examples differ, when the car gets to the top of this hill and it's going to come back down, gravity does the work. So the car needed fuel to go up the hill, and then physics and gravity determine that the car will then roll back down by itself. There is no such thing as gravity in Forex. We need fuel or volume for the price to climb. We then need fuel or volume for the price to come back down. So if we understand that, we can look at the difference in two levels. The first of which is going to be this consolidation. Ignore the fact that it potentially looks like a flag at the moment. We've had a nice upward trend and the price has then started to move sideways, moving into this correction, creating these two levels as it's gone. There could be a number of reasons as to why the price has started to move sideways into a range. For example, it could be a bank holiday, it could be towards the end of a session, we could have big news later in the afternoon or later that day that is then potentially going to give a breakout and we'll see the price move. But in other words, there's no real direct reason that there is an intention of this level being rejected. If we then look at an impulsive level, our price has moved up, it has then been forced in the opposite direction, showing us a direct intent of the price being rejected at this level. So that does not mean that we can then make the assumption when the price gets here, we can sell and the price will then fall back down. But what it does mean is if it showed an intent previously, there's a much higher probability that it will show an intent if the price then reaches it again. So if we do come back to this level, find a confirmed entry here and be able to write it down, we know that we've got this level is intentional. So anything that forms here that gives us a confirmed entry is much more likely to give us this move. On the other side of the coin, if we break that level and then reapproach it, there's a much higher probability that the price will show an intent to reject that level once again. On this side, so the consolidation side, you might see that the price breaks out, comes back down, and it's actually shown zero intent or paid zero attention to the fact that you thought there was a level there. What it's actually done is create an impulsive level here and an impulsive level here. And they are the two important levels, not these. The mistake that most retail traders make is they're looking for the most taps. So they're looking for the level that's got 6 or 7 or 8 taps as opposed to the level that may have 2 or 3 but is impulsive. So I am not saying that a good amount of taps on a level isn't important, because it definitely is. We need a minimum of 2 to find, 3 to identify, and any impulsive rejections that we get of that level pushing forward from that just further confirms that that level is showing us some kind of relevance. But we should be looking for these impulsive levels and not levels where the price action bundles up and just gets choppy. Let's look at an example of where consolidation has been beaten by impulsive. So just here we can see our price has moved into this consolidation or this range, creating this nice lower level here. Going on the trading strategy of looking for a break and a retest or a bounce of a level of support or resistance, which, as I already said, that's not a trading strategy, that is amateur. These levels should be used as a confluence to find trades, not trades themselves. If you're trading based on a bounce, over here we're going to have been alright. We've got our bounces, we've got our move away. There's no real way to invalidate, there's no real way to find targets. When we get down here, you're going to be disappointed because we look like we're going to get a bounce. We've then smashed straight through as we've re-approached. So you're now looking at break and retest. You'd expect it to fall back down. In actual fact, where it's not an impulsive level, it's paid zero attention to that. It's punched straight back through and the price has gone choppy. And we've seen 4 or 5 movements where it's shown us that this level actually means nothing. It's just there to generate noise and throw us off the scent of what's actually going on. If we look where our price has actually pulled back down to, once it's broken through this level, before it's continued its move to the upside, we have got an extremely impulsive level just here. Now it's only giving us 2 taps. So most retail traders are going to look at this and say that's not the relevant information. This is the relevant information. When in actual fact, if we extend the level across, we can see that it has resembled a perfect relevance. Now this obviously isn't going to happen all the time, and that's exactly why we don't trade support and resistance. These levels are there, as I say, to look for trades or to add a confluence to a setup. They are not there when we approach a level of support to just look for a buy, or when we approach a level of resistance to just look for a sell. They are there to support our analysis and add structure. If we are paying attention to just these impulsive levels where we see these strong rejections or an intent to reject a particular price, there is a much higher probability that we will then get the same when we reapproach it. Marking up charts like this is also another great way to filter out the noise. So a lot of people carry out top-down analysis, but they might find that by the time they get to the 15-minute or the 5-minute and they're looking for their scalp or their intra trades, that their charts resemble something like this. And they have no idea what level is what, how relevant it is, and whether it's actually going to pay any relevance when the price physically approaches it. If we are just paying attention to the impulsive levels, it allows us to keep our charts clean and focus on what's important. And there is a much higher probability that when we approach that level, we are going to find the kinds of trades that we are looking to take. Another big mistake I think most retail traders make is that in the Western world, we're taught to read from left to right. When in actual fact, as traders, we know the most important price action is the most recent price action. So if that's the case, we should be reading a chart from right to left. The most recent price action will always show the most relevance when the price reapproaches it. Just because something was relevant back in 1993 doesn't mean it's going to be relevant today when the price reapproaches it. If it's relevant across the whole history of the pair, then fantastic, that's great. It adds an even stronger confluence to the setup. When we're looking at marking out impulsive levels, because again, even from a top-down perspective, we don't want to be paying too much attention or any attention to these corrective levels. We're interested in the impulsive levels, and that doesn't matter whether we're marking out trend lines, channels, patterns, support, resistance, anything at all. We are just focusing on those impulsive levels and the most recent impulsive levels and rejections. So when we get something like this, where we've clearly got a double rejection and they both look relatively impulsive, we're going to want to take the most recent low into account. A lot of traders are marking up off the bodies, which is fine if you want to take a higher risk strategy. But ultimately, you need to understand the importance of what wicks are and what they show us. They show us rejections first and foremost, but they also show us the extremities. So if we're looking for a break of these lows, we have no way of confirming whether shorts are in play until we take out these extremities here. Likewise, looking for a rejection. We've got no way of knowing whether we're going to get a bounce off of an impulsive level and see a move to the upside until we take the extremities into account. This is even more important if you're looking at patterns trading. The wicks and the extremities must always be considered. We always want to be looking at them. It can mean that you miss trades, but the way off there is going to be that you get higher probability setups. In my opinion, if it's a question between taking more trades with a lower probability or taking less trades with a higher probability, taking less trades with a higher probability is always going to win. As I said at the start of the video, this is not a trading strategy. Trading support and resistance is amateur. You need to add something further to your trading strategy if you want to find any form of consistency. And it's for that reason that I wanted to keep this video short, because ultimately support and resistance are not going to get you in trades, but it is going to find you some nice levels and give you a decent structure that you can then build on. Drop a like and subscribe to our YouTube channel. If you like what you've seen in this video, sign up to our mentorship program and we can push you even further. We want to make even more funded traders this year than we did last year. Are you going to be one of them? If we're giving this kind of stuff for free, imagine what's in the vault. Follow us on Instagram at TP_effects and jump on our website, because we're going to be putting more stuff in our free resource section, www.tpeffects.co.uk. Learn to read a chart and react, and not predict.